Hello and welcome to FT Markets. This week it's seen some extraordinary bouts of volatility across bond markets, in particular the German market, but also across the Atlantic in the US. Joining me now to discuss what's going on and why investors are fearful that this could just be the start of a very volatile period this summer, I'm joined by Joe Rennison, who's our markets reporter from the US, who's currently here in London for a bit. Joe, is it liquidity?
I think it's definitely liquidity. Certainly speaking to investors and banks, that's the persistent message that kind of comes through. We saw it at the end of April coming into May, and it's a very similar story now. What's interesting is that rather than this being a sell-off in cash bonds, it's being driven by futures markets. An inability to sell or a lack of desire to sell in cash markets means people are turning to futures to hedge or to guard against future moves.
Okay, so let's bring up the chart here of the 10-year Bund, and you can see an extraordinary move this week. Essentially, the market was below 0.5%, and in intraday trading on Thursday, we got just shy of 1%. It's an incredible move, and again, a lot of people saying it was the activity in the futures market that pushed this, but I'm also hearing that the liquidity in futures trading itself associated with government bonds is not very good either.
Yeah, and it's a really difficult thing to actually evidence, but certainly anecdotally, and there are indicators as well, we're seeing that whilst there's a lot of volume going through futures and a lot of trading happening, what's difficult is the inability to put through large size without moving the market violently, significantly.
Now, while this was going on, of course, we had an ECB meeting this week, and Mario Draghi made a very interesting line. It basically told the bond market, yes, it's volatile, get used to it. How did that go down with the market?
Well, I think depending on who you speak to, depends on whether there was surprise or not. But certainly what we saw on Wednesday with yields spiking in bunds was driven by a very strong point by Draghi in saying that this is how markets are now going to trade. This is what we should get used to moving forwards.
Right, and we've sort of been through this across the Atlantic in the US, and if we bring up the chart here of US Treasuries, we can see even in the US this week we've had a big move. In fact, it's been going for a while now, last few weeks. And I suppose ECB is still planning to keep on doing quantitative easing, i.e. buying lots of bonds until next September of next year. Fed has stopped doing QE, and all the focus is now on, okay, when does that first rate hike come? And so, again, though, this is the world's biggest government bond market, over 12 trillion in outstanding issuance. How badly are the liquidity issues playing out at the moment in treasuries?
Yeah, I think this is exactly the point, the fact that we're in this intermediary point between the end of QE and as rates rise. And people turn to treasuries, obviously, because they're a liquid market. They're the grease, the oil in the market that lets everything move around. Yet still, even here, banks, investors complain that putting through large size, getting trades done quickly in a timely manner is proving difficult, and that's significant, because when it's affecting a high yield corporate bond and there's a lack of liquidity there, that's one thing. But when it's infiltrating treasury markets, that's quite another.
So the sort of takeaway here is that this week could very well be just a taste of what's to come.
Exactly right. As we move into the summer, especially with Draghi's comments, I think traders are preparing themselves for more volatility, more violent markets.
Great, Joe. Well, thanks so much. And on that note, it's certainly going to be an interesting summer to watch how the bond markets behave. And in particular, not just from a liquidity perspective, but really the big issue is when will the Federal Reserve actually look to raise rates? And I suppose that's the real open question at the moment. It could be later this year. It may be pushed out to next year. But either way, it promises lots of volatility and continued big swings in the prices and yields of treasuries and other bond markets.